Somebody asked me to put together a relative valuation model. So that's what I did. So this is, I think there's a lot of different ways to do this, but here's one approach. So I just picked 3 companies you want to pick in the same industry. Well, just to backtrack a little, relative valuation is just another way to value a stock. It's commonly used in real estate, because if a home is for sale, you don't run a discounted cash flow model. You just look to see what other homes sold in the neighborhood of similar characteristics. You wanted to get something relative to that asset. So that's kind of the idea with this is you can pick companies that are similar. Sometimes that's hard to do, but I picked Coke, Keurig, Dr. Pepper, and Pepsi. And this is the model. So you just have to input everything in blue. So Coke. So stock price 64. So I put the stock price in, shares outstanding. It's all from Yahoo Finance in this statistics section. After you find a ticker. So shares outstanding, 4.3 billion. It's formatted to millions. Market cap is calculated. It's shares times share price. And then net debt, you could get that from Yahoo Finance. Maybe I'll footnote this. It's total debt minus cash. That's what net debt is. And then EV, enterprise value. That's also calculated because enterprise value is market cap plus net debt. And then revenue, you got to pull that. From Yahoo Finance. And then EBITDA, same thing. We pulled that number, 14 billion. Net income, we pulled that number, 10 billion. And like usual, this is the 5th model I created. So if you want a copy, just email me. And I'll send you a copy for free. As long as you promise to watch this video 100 times without sleeping. So 100 times, but you can't sleep. So it has to be in the same time period, like in one day, not like 100 times over a month or 2. You can do it over 2-3 days. You just can't sleep. David, were you the one who suggested this? I can't remember who suggested it. It's a good idea. financial.business.consultant.sr. Scott, been watching for years, despite my name. Left a lot to do invest in stocks. Some of it. I used to be a degenerate sports gambler myself. What's a model? I will never get them. When I started college, I started betting. I'll save it for another stream, but I lost like $10,000, which was almost all my bar mitzvah money. And then I gave my mother my checkbook. We used to have checking. We used to have little books. So when you went to the bank, you give them your book, and they would print the new balance. I just gave it to her back. I said, I don't want access to this anymore. I'm going to lose it all. But anyways, okay. I thought I had this great strategy to bet on football, and it didn't work out. So So it's hard to compare different companies because most companies aren't the same exact size. Um, like even Coke and Pepsi, they're similar size. Coke is 270 billion market cap. Pepsi is 220 billion. Keurig Dr Pepper is 44 billion. So what's the best investment? Maybe Keurig Dr Pepper because it's cheaper. Just because it's cheaper doesn't mean it's a better investment. It could be a better investment, or it could be Dr Pepper could be really overvalued. You don't know. So that's the point of this. So we get all these inputs: revenue, EBITDA, net income, share price, shares outstanding, and net debt for all the companies. And then we get the multiple. So these are the valuation multiples. I should change that to multiples. Price multiples. I think that's more. Okay. So we need the EV over revenue for each company. So EV over revenue. And then EV over EBITDA for each company. And then the PE for each company. And it's all calculated because once we have these inputs, then it's just the formula. Now, this is where kind of it gets so there's only 3 companies, so it's kind of a small sample size. If you were doing like 10 companies, it may make more sense, but it's still the same approach. So I'm taking the median for each column. So the median for EV over revenue is 4, which is Keurig Dr Pepper's number. You could do the average. The only problem with the average is if there's like sometimes there's a big outlier and then you need an implied. Well, I'm doing a valuation on Coke. And I'll make a video explaining this, but so the top company is the company you're doing a valuation on. So if you wanted to buy Coke, this is the process you would go through. You would get the implied enterprise value for Coke. So the implied enterprise value using the EV over revenue multiple is you take that 4 multiple times the revenue, Coke's revenue. Because you're kind of trying to take 3 different companies and equalize them all. That's what you're really trying to do. And that's what you do when you invest anyway. You're trying to figure out, you can't really compare. You can't say NVIDIA is the best company in the world because they're the biggest. You don't say that. It has nothing to do with how big a company is or how small a company is. You're trying to value them. Are they over or undervalued? And NVIDIA may be really undervalued. They could be the biggest company in the world, still be extremely undervalued. And the smallest company in the world could be overvalued. Or that's not the case. So you get the implied enterprise value on each of these multiples. And then you minus the net debt. So the implied value for Coke, based on the multiples for the industry, is between 189 billion and 286 billion, depending which multiple you use. And then the net debt is specific for Coke because that's how much debt they have remaining after using the cash. Because just to say, they have 45 billion of debt and 8 billion of cash. So you could see Okay, that's good. Well, I typed it in wrong, but that doesn't matter. I mean, what? How did I do that? Maybe I was just looking at the wrong screen. Okay, let me put in the right 47.12 minus 18.16. Let me just double check these numbers. Dr. Pepper 16.8 minus 552. I remember typing that in. Maybe I swapped Coke and Pepsi. That's what I did. I wrote Coke's net debt in Pepsi and vice versa. I mean, that would be important if you're actually valuing these. 45 minus 8. I guess I should double check all my numbers. 163, 224. Yeah. Revenue. Pepsi's revenue is always so much higher than Coke's. I don't know if anybody's noticed that. Pepsi's revenue is nearly double Coke's, and Pepsi's a smaller company. Do you guys know why? I mean, it's a pretty obvious reason once you know why, but okay, I think I got the other numbers right. Okay, everything else is right. Okay. Pepsi also owns snack brands. They do. Coke's bottling is separate. They do have a separate. The ticker is Coke, COKE. That's their bottling arm. It's a separate company, but it's half owned by KO. So you're getting the industry median. And this was if this was a larger sample size, it would make a little more sense. But and then you're applying the industry median to Coke's revenue to see how much they should be worth, like their implied revenue, if they traded at the same multiple as the industry median. And then you minus in that debt because they have 47 billion of debt, 18 billion of cash. 47 billion of debt, 18 billion of cash. So you're assuming they would use all the cash to pay down the debt, and then the remaining debt is 29 billion. So that's why you minus it from the implied enterprise value. And then you get an applied market value. So the implied market value is 161 billion up to 249 billion. And then you divide that by the shares outstanding, and you get an implied stock price. So you can see their implied stock price is between 37 on the low side and 58 on the high side. And they're trading at 64. So based on a relative valuation analysis, you would deduce that Coke is overvalued and you wouldn't buy them. And I'm sure if you did this for Dr. Pepper or Pepsi, probably one of these two would be undervalued. Because if something is overvalued, something else has to be undervalued. Especially if there's only three. Pepsi makes more snacks, and that's why their revenue is higher. Well, no, I mean, if they make more revenue, why is their market cap lower? Like, they always have like a lot more revenue. Like, it's not quite double, but it's like 95, almost double. But they're smaller. They're a smaller company. So that's what I'm saying. I'm saying, why is that the case? I mean, they do similar things. So why? I mean, Pepsi should be twice the size of Coke, right? because they do almost identical things and they double revenue. So that's it. That's the relative valuation model. Some people, it's a little easier to do than DCF. DCF, I mean, they're all kind of easy once you have the Excel file, but it's the inputs are easier for this because DCF, there's a little kind of guesswork involved. Like what's the WACC? What's the how much of the free cash flow is going to be in the future? This is just the numbers are the numbers. You don't really make any judgment. You just plug in the numbers. Lower growth rate? No, I mean, for like decades, it's been this way. Coke is always smaller than Pepsi. I mean, Pepsi's always smaller than Coke. How come they don't have a revenue? And the revenue is so much larger at because that's why Buffett buys Coke, because Coke has a brilliant business model. They don't really, most of the Coke that people drink, Coke doesn't make that. But most of the Pepsi people drink, Pepsi makes the drink. Pepsi, bottles its own stuff and sells it. Coke just sells the recipe to the bottlers. They don't actually manufacture. They do a little bit, but most of the beverage is manufactured by the bottling companies. They just provide like the ingredients, and the bottling companies do all the hard work. That is hard work to manufacture all the soda, and then you have to ship it out, and you have to organize with the retailer how much they want. So that's not an easy job. It's a very easy job what Coke has done. They just send the ingredients out to the bottlers, and then they do all the work. So their margins are really, really high. They're very profitable. Coke cheated. They used World War II to get the government to stand up bottle makers across the world. So yeah, so if you look at their profitability, they're much more profitable. Like, look, they have half the revenue, and they're more profitable than Pepsi, because it's a very great business model. It's all profit. They just make the what percent of Coke's product? I don't know if I could. Do they bottle? Yeah, they just sell the concentrate, like the syrup, and they probably sell in huge buckets of syrup. But I don't know if you can figure out how much they actually make, because they don't really. I don't know how much does Coke make anything. Yeah, so that's pretty much the reason. Because when you invest in Coca-Cola, not Coke, COKE is a bottling company, but COKO, when you invest in Coca-Cola, and I said, how do they generate revenue? And you would think from selling soda, but they don't really sell much soda. They just sell the syrup, and then somebody else sells soda. It's a really brilliant business model. So yeah, so email me This obviously, it makes more sense when you do it yourself, and then if you look at the formulas and you start to understand how it works. But this is a pretty straightforward valuation model. I was going to try to show you like an example, but I don't know if this would work. Let me see if I could do it this. Let's get the median. This is semiconductor companies. I think it's just a good industry to. These are just the top 20. So the median for the industry is 33. So if everybody had a 33 PE, then we're gonna get an implied market cap. This is much more simple than what I did, but we'll get an implied market cap, assuming everybody shared the median PE of 33, and then we can see who's over or undervalued. Shit, I need the earnings though. Do I need earnings? How can I get at this without having earnings? Market cap. Let me just get the earnings. I shouldn't have left the screen. Industry financials. Net income. Net income. I understand why it doesn't have it. Okay, so I guess I could just back into the earnings this way. So the earnings would be the market cap over the PE ratio. Let me just confirm I did that right. Yeah. Okay. So Intel's not a good example because they have negative earnings. Okay, so if these are the top 20 semiconductor companies, and the PEs have a pretty big range, right? But the median for the industry is 33. So because there's always going to be outliers. There's always going to be these companies like ARM has a really high PE, and even there's negative PEs or really low PEs. But those outliers end up adjusting at some point. It takes a while. Could take a few months or a few years, but you can't run at a triple-digit PE forever. Eventually, you come down, like Tesla and Amazon did. So if you assume everybody's going to kind of revert to the 33, the median in the industry, and you apply that to all these companies. So this is the implied market cap. Like if NVIDIA got to the 33 PE, their market cap would be $2 trillion. So Qualcomm should double in price, according to this, because they're 91% undervalued, because they have a 17 PE. If we force them a 33 PE, then so it's kind of like the same idea. You're just kind of like trying to fit every single company into one number. So that's what the relative valuation is. Okay. So any questions on this? Yeah, feel free to email me. It might be easier to use it. But it's a, I mean, with every valuation, there's a lot of like positives and negatives. So there could be there's a lot of things that could make this like would probably not, like in certain extreme situations, it doesn't give, it definitely wouldn't give a good value. But it's, yeah, but I don't really use it. Somebody suggested it, and it's not a bad approach. You can see it does give a real value for Coke. That's their range. But this is like, it's kind of, we're forcing Coke to have the same multiples as Dr. Pepper and Pepsi, because Coke is the most overvalued in all the multiples. Same thing like NVIDIA would be all overvalued in all their multiples. So that doesn't mean you shouldn't buy Coke or you shouldn't buy NVIDIA. So yeah, I just did a video on StarBulk. That seems, if anybody follows, I know a lot of people like it because of the dividend. It's like, it's extremely high. So currently the yield is, well, this says 6%, but why did it say so low? Let's call it. Yahoo Finance says 14%. I wonder why. Okay, so this is why. So this is using the trailing yield. So 70 plus 75. $70, $75, $45, and 22. I'm at 12. I wonder why it's so. December 2023, March, June, August. Annual dividend $1.42. Yeah, I don't know how they get this annual dividend of $1.42 because $1.42. This could be wrong. $1.42 is 8%. That's August. So maybe because I think. How do you like Business Quant? Had never heard of it. It's good. I mean, it's free. They gave me a free subscription, so that's why I use it. But I mean, I like it because I use it for the the industry comparison chart when I compare all the companies in the same industry. So that's really what I use it for. I've tried other things, but I don't really use it for much else. I don't think it's cheap either. I think it's like $40 a month. Yeah, I just use this industry financials to compare all the companies. But they have a lot on the website. It's a little kind of like no frills looking, kind of basic, but it gets the job done. Well, I think because the yield, this is as of August, and you can't go up to December 2024. It doesn't. I guess that's why, but dividend March. Yeah, it's fine. So StarBulk, big dividend. They just acquired they acquired somebody. Eagle. Yeah, Eagle Fleet. They didn't they merged with Eagle Fleet. And that added like 50 vessels to their portfolio. So they're getting vessels. Yeah, so they're like, I think they're top, I think like the fourth biggest, maybe sixth biggest marine shipping company now. Seventh biggest. 2 billion. I mean, still pretty small company, 2 billion market cap. Zim is moving up. They're 2.5 billion now. And look at Zim's price to free cash flow is 1. Price at PE is 1.8. So they look really undervalued. But it's Yeah, it's pretty volatile, the industry. It's these stocks move around a lot. It's not I mean, Zim's probably up like 200% this year, 250%. Yeah, they're up 189% for the year. I mean, they were trading almost $90, and they came down to like $7. So I know there was a lot of buying up here when the stock was they were paying like an 80% dividend yield, 87% at the peak, and they paid it for 2 years. They were paying a dividend like over 30% for 2 years. But then they just totally eliminated the dividend. They did bring it back recently, but they're going to probably pay another really big dividend because yeah, they IPO'd at like $7 in November 2023. They IPO'd for $7. Imagine buying it at IPO, and then they paid a $17 dividend just in one quarter. So that's like a 200% return just in that one dividend payment. Like that's just crazy because they have to give out like they say it in their prospectus, like they'll pay like 50% of their earnings they'll give back as dividends. So the earnings were just so high, so they had to pay it, and they were still paying like the following quarter they paid $285. After that they paid $475. I mean, could you imagine buying it for $6 and getting those dividends? And they even paid $6.40 before they eliminated the dividend. I don't know. I mean, hindsight's 2020, but I mean, I can't. It's like gambling. Investing in a stock like this, it's really a total gamble. Yeah, so I'm getting close to 40,000. I could finally do a portfolio reveal. It took me almost 2 years to get from 30 to 40. It took me like to get from like 20 to 30, it took 6 months, and it took 2 years to get from 30 to 40. So 204 to go. This guy keeps, this is like a new scam, because I've seen this comment on other channels. He says, a great analysis, thank you. Let me, it's a weird scam because I don't know what he gets out of it. He must get something out of it. So this is what he writes. I did reply to the first one. It's like, great analysis, thank you. I need some advice. I have a Safe Pal wallet with USDT. That's the crypto that's pegged to the US dollar. So it's always one It's always equivalent to a US dollar, the USDT crypto. So I have the seed phrase: alarm, fetch, churn, bridge, exercise, tape, speak, race, clerk, couch, creator, letter. How can I transfer them to Binance? I don't even know, like is that what do you get? Is that how you get your code? You have a phrase. You have to enter this phrase. Is that how crypto works? I never even knew that. I don't know why they want to steal your crypto wallet. It kills me seeing how much Nvidia went up. But I mean, how would you possibly know? You can't invest in every stock, and you're not going to put your life savings in it. You're not going to put all your money into it. Maybe you would put a few thousand, but you have to hold it for over a decade, unless you bought it like in 2022. It did 10x real fast, but there was a long stretch where like 7-8 years it didn't really move. So how would he steal my, like, there must be something like that. Like, what would I do? Like, how would he get my access to mine? I just responded, just said, just call SafePal or Binance. SafePal. Crypto hardware wallet. But I did respond. He never responded back. I bought 100 of Bitcoin, and it's up to I bought it through Venmo. It's up to 326. So I bought 100. That's pretty good return, right? Too bad I didn't put more into it. The only reason I bought it was because I was paying somebody in Bitcoin, and I never got a chance to pay them. So it's just been sitting there. If you search the comment on Google, it will probably. Oh, that's a good idea. You have a SafePal wallet USD. What's the best way to send them to Binance? What happened in World Crypto? This content was really helpful. Received USDT, immediately transferred out. Yeah, I don't know. So the one stock. Oh, did you see the stock? Unusual Machines went up 89% on Friday alone because they put Donald Trump Jr. on the board of directors. That's why. Isn't that interesting? It went 89% on Friday. It opened Friday at like $10 and closed about 19. So drone company stock soars after appoints Donald Trump Jr. to advisory board. So they put him on the boards to help them because the company relies on Chinese imports and is concerned about tariffs. So if they put Donald Trump Jr. on board, maybe he'll convince his father not to impose a tariff on drones coming from China. Shares in a little-known drone company soared Wednesday after announced Donald Trump Jr. Oh, right, it's Wednesday because it was the holiday. User Machines, Florida-based firm, 2 years ago, it acquired a drone manufacturer. That's one way to do it, is just hire the president's son and give him money. The need for drones is obvious. It is also obvious that we must stop buying Chinese drones and Chinese drone parts. I love what Unusual Machines is doing to bring drone manufacturing jobs back to the USA. After Unusual Machines announced Trump's move, its stock price doubled. It was below $1 in May, and now it's $20. Drones are a security threat. So he gets 331,000 shares of the stock. I didn't realize drone manufacturing was not allowed in the US. Okay. DJI is the world's largest drone manufacturer. So that's crazy. You can't manufacture drones in the US? Who manufactures drones in the US? Inspired Flight is a drone manufacturing company that was founded in 2017. Did they have to stop Inspired Flight? That sucks if you built a business to manufacture drones and then the US said it's illegal. American-made drones. Maybe certain drones can be made in the US. Like it has to, maybe you can't have it above a certain height or something. I don't know. You can manufacture the cheap drones, inexpensive drones. The commercial drones, that's pretty cool though. Isn't that cool to have these drones? Other U.S. drone manufacturers, several American drone manufacturers offer a range of products. Prominent examples include I guess it's certain. I guess certain you could manufacture certain drones. Probably the ones that are like just regular people use for fun. But if for serious drones, like for business purposes, I guess you can't if it's a national threat. Yeah, it would be a good investment, right? Maybe we should buy this company. What's talking? I can't remember the name of UMAC. UMAC. It's up 325% this week. Wow. Imagine buying options. You could have made like $50 million. I mean, how would you know that, Ro? But if you bought, it started coming up though. It was $2 for a while, and then it was $2 up until November. So it went from 2 to 19. Why is this company actually ran well? Are they cooking the books? What's with wait? What do you mean? Why they ran well? I don't think there's anything like. It's just they appointed Donald Trump Jr. That's the only reason the stock has gone up. I don't think there's any. I don't think they've done anything special. Are you talking about StarBulk? Let's see their revenue. Yeah, I'm not surprised. They really didn't have any revenue. Their pre-revenue until this year. I mean, 3 million of revenue. It's good if it's for a small business. The stock is 155 million. So they're trading at 50 times revenue. You always wonder, is this a good investment? More for a swing trade, because is it going to keep getting pumped up for another month or two? You can't really win with these stocks, because even if you do buy it, if it starts, you never know when to sell it though. Like, could you imagine like owning like Nvidia, putting 10K into Nvidia and selling it when it was 50K, and it could have been 2-3 million? It'd be a nightmare. New York Seam. They have 3 employees. There's been insider buying. There's going to be some selling now the stock went up so much. So the board members, they probably haven't updated this yet. It doesn't mention Don Jr. Yeah, it's just like a joke. Like, how could you be a public company with 3 employees and no revenue, almost no revenue? The only people that make money are the people who start the company, because they end up selling, like, they make like millions from selling stock, and then it eventually goes out of crashes the company and goes out of business. But they were able to make some money by selling stock before it crashed. It looks like a SPAC, but I don't think it's a SPAC. Like, how could a company like go public like this? Retail revenue. So they did have some revenue, 1.6 million, or 1.4 million. The drone market size. $13 million of fully diluted shares. So it's going to, if you own the stock, you're going to get totally diluted out, and it's not going to be worth anything in a couple of years. I should see if I can do they could do a live stream with me. Well, REITs are different. REITs are, you don't really need a lot of employees to be a REIT. You just need a handful of employees to manage. It's kind of like what Buffett does. He just invests in businesses. He doesn't really run those businesses. Like, Apple has a lot of employees. He just owns Apple. So REITs just have, usually it's real estate, and then they rent it out. They rent it out to whatever types of businesses, like hospitals or retail stores. So it's like, if you rent a building to a hospital, you don't need to staff the hospital. Like, you're just a landlord. You probably need a few employees to make sure they, rent is paid on time, and if we need to fix something up with the building. But I worked for a real estate. I work at a real estate developer, and I work for real estate companies. You don't need, even the people who fix the stuff I worked at this place. I was consulting, and they had like five properties, like shopping centers, and it was just 5 or 6 of us in the company. 2 or 3 were in accounting, and then there's another 2 or 3 in like the front office, like showing people the properties, things like that. But even the people who fixed the property, they weren't even employees. They were 1099s. So we just, like independent contractors. So we would just pay them for each job they did. Even marine shipping companies, some of them don't have many employees. But this is a real company that makes a product. Usually when you make a product or provide a service, if you're a public company, that is, you should have a lot of employees. Even if you're a small public company, like even if you're 500 million market cap, you still might have a few hundred employees. UMAC looks like a patent company playing. Oh yeah. Oh, they yeah, that makes, I guess, more sense. So what's the term? There's a patent. Well, I know. I used to. I remember. I used to call it patent trolling. They would just buy patents. A company would just buy up patents in open market, and then hold the patents, and then sue people that infringe on the patents. So is that what they're doing? But they're actually making a product. They're not just. I mean, they may get. I'm sure they're going to get a patent for the product. Unusual machines. What company? I actually worked. There was a focus group I went to like a year ago. It was with, I can't remember the company, like a big company like Google, Apple, one of those companies. And like a company bought up patents and then sued like Apple for infringing on a patent. But like you can just buy a patent and never ever make a product. Just hold the patent. And then when someone makes a product, like a company like Apple makes the iPhone and sells it, then you could sue them for infringing on the patent, even though you never made a product and never had a plan to make a product. But you can try to justify how your patent is kind of close to some of the products on the iPhone or whatever. It's kind of a silly way to make money, but I guess it's legal. So unusual machines. But even if they're at a small scale, they should have a lot more than 3 employees. Because usually when you like that happens a lot with pharmacy companies. Before they develop a drug, before they make any revenue, they do a lot of R&D, and it could take years to develop a drug, but they have many employees working there. Even though they're not making any money, they still have a lot of doctors or employees working, scientists, to develop drugs. So just because you're not making a lot of money, you generally, if you're making a product or planning to make a product, you should have a number of employees. What are you doing? Like just sitting around collecting money? Donald Trump joins a U.S.-based drone components manufacturer today announced. Don Jr. joining our board of directors provides unique experience. The need for drone is obvious. They manufacture and sell drone components and drones across a diversified brand portfolio, which includes Fat Shark, the leader in first-person view, ultra-low latency video goggles for drone pilots. The company also retails small acrobatic FPV drones and equipment directly to consumers through the curated Rotor Riot e-commerce store. I feel like Hindenburg. This is what Hindenburg does. They kind of like pick apart everything they say. With a changing regulatory environment, Unusual Machines seeks to be a dominant tier 1 part supplier to the fast-growing multi-billion-dollar U.S. drone industry. The global drone accessories market is valued at $17.5 billion and is going to grow to $115 billion by 2032. Let's see, Fat Shark drone. $20,000 for a drone. And that's expensive. So Fat Shark, so they sell, unusual, they manufacture and sell drone components and drones across the verse, which includes Fat Shark. So they sell Fat Shark drones. This Fat Shark is a real company. How do they get the? Like Fat Shark sells Fat Shark drones. Like that's obviously what they do. They manufacture drones, and these are retail stores that sell their products. So if you want a Fat Shark drone, you can go to these retail stores. I don't see how Unusual Machines is connected. Maybe they sell parts to Fat Shark drone. They sell like maybe some like maybe there's some part of the drone that this company specializes in, and they sell that part to Fat Shark. The company also retails acrobatic FPG drones. So they retail to consumers through the Riot e-commerce store. Also remember, Ukraine war had made drones famous. They are in high demand for military. Rotor Riot e-commerce store. So they sell drones on this website. Unusual Machines. I emailed Hindenburg. I asked them if they are looking for consultants. They never responded. Unusual Machines, right here. Okay, so that gives them some validity. So Unusual Machines is listed on their website. So I think Unusual Machines sells something. I don't know what they sell, but something related to the drone. And other companies sell the actual drone. Unusual Machines they just sell drone components. But they say and drones, which includes Fat Shark, retail small. I'm going to email them. Buy one of their drones. But they don't sell anything. I mean, these companies do. Well, Unusual Machines. Like if I go to their website thinking, okay, I want to buy a drone, like I don't think they even sell drones. There's no there's no way to buy it. These other websites sell drones, but I don't even if I type Unusual Machines, nothing comes up. Or if I go to Fat Shark, obviously I could buy a lot of things from Fat Shark, but I don't know. That's what I think. I think they sell something that's related to the drone, but they don't actually sell drones. Like if you sell like like the battery that goes into the iPhone, like you manufacture those batteries, no one would never know your company. Everybody knows iPhone because you bought iPhone. No one would ever know your company because you got it. You would buy everything through Apple. Like, so your company's kind of just a cog in the process, which is fine. I just want to understand what they do, and I don't really know what they do. It's a good short, but I don't know. I mean, I don't know when. They raised a lot of money. Because this is what I usually try to do. Okay, they announced their IPO. The company expects to receive $55 million from the offering. Unusual Machines completes okay, so they acquire these companies. Okay, so that makes sense. So Unusual Machines is not like, no one would ever think of Unusual Machines when they think of drones. But Fat Shark, I'm sure if you're into drones, you probably know Fat Shark. So they bought these companies. Okay. With the acquisition of Fat Shark and Rotor Riot, Unusual Machines is well positioned to serve. Integration of Fat Shark and Rotor Riot is into Unusual Machines expected to bolster the company's market leverage position, leveraging Fat Shark's. Okay, well that makes sense then. It's kind of like Alphabet. Like, now everybody knows what Alphabet is, but no one thinks of Alphabet. Google is a company or the website, but Alphabet owns Google, just like Meta owns Facebook, Instagram, but you don't think of Meta as. Okay, well, yeah, like Meta. A lot of times companies do that. They set up these entities as kind of like a tax shield or a liability shield, because you don't want to put all your assets in one entity. You might have all your assets in one entity, but then you create another entity that's kind of sits in front of it, your operating company. So if somebody sues you, they can't. I don't know. That's the idea, at least. I don't. Meaning you like the brand or product before knowing about the stock. Do you buy stocks in brands or hobbies you like? Not usually. Well, Netflix, I like Netflix, but that's not. I mean, well, it depends. Yeah, I mean, it probably helps if you like the product, but there's some products I really like, but there's no way I would invest in the company. I'm trying to think of an example. I can't really think of any, but like Logitech, I bought my Logitech mouse, which I like a lot, But Logitech is a good company. Maybe I should consider buying it. Okay, well, let me know. So I have now five Excel models. So so email me and I'll send you a copy. So now I have the relative valuation model. Yeah, so try to. Oh, I still need to create the video. I haven't made a video yet. So this is probably. Yeah, I got to come up with a video. Okay, well. Yeah, I did. I did a relative valuation today. The first one was a DCF, which is, I guess, the most popular. The dividend discount model, the options model, all the financial ratios, and I'm doing it myself, so I think it's pretty user friendly. Because I've looked at some models, because I try to download some models, so I'm like, okay, let me download it and then I'll tinker around with it. But they're so complex, some of them. There's just so many things going on, I can't even keep track of everything. So I just want to make it real simple. That's more likely. A stock will make me more familiar with the product. That definitely happened. But okay, well, thanks for joining. Hopefully I'll get to 40,000 by next week and I could do a portfolio reveal. Okay, I'll talk to you later. Thanks.